You're welcome back to the Forex Geek channel, guys. In this video, we are going to be discussing something important. Okay, so stay tuned. Now, most traders lose because they are trading what they see, not what is actually happening. Okay, so let's just fix that. This is liquidity trading simplified. Okay, that's what we're going to discuss in this video. We are going to be looking at a step-by-step course that will change the way you see the charts forever. Okay, first of all, let's just define liquidity in the simplest way possible. Liquidity is the fuel that moves the market. It is not just volume. Okay, it is where the money is sitting. Liquidity pools exist around obvious price levels like equal highs, equal lows, support, and resistance. Those are areas where you likely find liquidity pools. Okay, areas where you have, equal highs, right? Areas where you have equal lows. Let's see if we can find an equal low. Okay, I think we have one around here, right? And then you can also find, liquidity pools around support and resistance zones. Support zones basically where price, gets to and is rejected. It's a zone. It may not necessarily be, an area where the lows are equal or the highs are equal. These ones are actually called zones for a reason. They are called zones for a reason. Okay, so this is a resistance zone, for example. It's a support zone, for example. So even trend line touches, yeah, if you're familiar with trend lines, connecting lows and highs together, and all of that. So these are, different situations in the market where you can find liquidity pools. They are found around obvious price levels because that is where most stop losses and pending orders are clustered, right? Smart money knows this. They don't chase price. They engineer moves to these zones to collect orders. Now, there are two key types of liquidity that you need to understand, right? We have the buy side liquidity, and the buy side liquidity are usually above swing highs where short sellers have their stop losses. Okay, so let us use this resistance as an example. Buy side liquidity are usually found above swing highs. This is a swing high, right? This is a swing high. So they are around zones where sellers usually set their stop losses. So if a seller enter a trade around here, he will likely set his stop loss above these highs, right? So that is the zone where we have buy side liquidity. And then for sell side liquidity, it is below swing lows. Okay, these are where buyers usually place their stop losses. So it's called sell side liquidity. So these are the zones where institutions look to trigger liquidity grabs. They push price into those areas, fill orders, then reverse the market, leaving retail traders confused. So this is why breakouts often fail, okay? Because they are not real breakouts, they are inducements. All right? Now, the power of liquidity trading comes when you combine it with market structure. Okay, so here's the step-by-step process. First of all, you need to identify the trend or the range. Okay, so let's just go to the current price activity. Over time, this is the Euro USD pair, and this is one of the most liquid pairs that is traded in the world. Okay, the Euro USD should even be, if not the most liquid pair that is traded in the world, right? So we can see now that generally the Euro USD currency pair is in a bullish trend. Okay, so you have to identify the trend first of all. After you have identified the trend, the next thing for you to do is to mark equal highs and equal lows, mark the obvious support and resistance levels, and psychological round numbers. These are your liquidity pools. Okay, so now we have marked this support zone. Yeah, okay, we can see that we have another important zone around here, right? And this seems to be an equal high. Yeah, you can see that we even have kind of an equal high around here, right? Remember that these are areas where liquidity pools are found, areas where the smart money tries to take advantage of retail traders who place their stop loss, their stop losses around these obvious zones. So you have to mark all these important zones on your chart so that you don't fall victim of smart money. Okay, so you can see that we also have an equal high around here. It's a zone around here, and you can see what happened here, right? You can see that at the time that price broke below this zone, it was just a false breakout. Because it was just a false breakout, price eventually continued going up. So had it been you had jumped in to enter a sell after this breakout, you would have gotten stopped out. Meanwhile, the trend overall is a bullish trend. So this is also one of the reasons why it is always advisable you trade in the direction of the overall trend, okay? So that you don't fall victim of what you are not supposed to fall victim of. Okay, now once you have marked out all these important areas, just wait for price to tap into those zones and sweep liquidity. Okay, wait for price to tap into one of the zones that you have marked out. All right, you can see that we have another important zone around here. You can see that this seems to be an important zone where price has reacted to. You can see price reacted here, here. There was a range here, price reacted here and reacted here again. So you can see this is an important zone. Okay, so once price enters into these zones, you watch for how price reacts. You look for a shift in market structure, such as a break of maybe a lower high or higher low. Then you enter on the retest of the breaker or supply and demand zone. Okay, so let's say we have price come and tap into this. Let's say price comes to test this zone, or like what happened here. You can see how price came to test this zone, and then we had a serious rejection. And then although in this case the price did not exactly come all the way down to test here again, but it gave us a break of structure to the upside. If you look closely, you will see that we were having lower highs and lower lows before. Can you see? This is a generally bullish trend, but remember this is the 4-hour time frame. So within this overall bullish trend, this was a sell structure indicating an overall pullback, right? Now after that, this important zone was tested, and then if you look what happened here, we had a change of character, because from lower highs and lower lows we had a higher high form, right? And then you can see that a new market structure was formed, giving us higher high and higher low. As you can see, higher high, sorry about that. Can you see? So we are probably heading upward. So you'd have considered entering a trade perhaps somewhere around here when you find a good opportunity. Okay, so remember that institutions wait for retail liquidity to be collected, then they move in. One of the biggest mistakes traders make is confusing inducement with a real breakout. Inducement is when smart money tempts you into a position, maybe with a clean break above resistance, right? For example, um, could be a break above resistance, could be break below support, all right? Okay, can you see what happened here? Remember that trend lines could also, the testing of trend lines could also give you, areas of liquidity pools. Now, can you see what happened here? You can see what happened here, right? Can you see? Is this not a false breakout? This is a trend line, right? And you can see that we had an inducement around here. You will think that some traders might think that this was a legit breakout, but it was just a trap, right? After this trap, the price continued going back upwards. Okay, so it's just to trigger your entry, to trigger your sell entry, or to trigger your stop loss for a buy trade, right? So they're not breaking out, they are just baiting liquidity. The real breakout only happens after the liquidity has been taken and price breaks structure in the opposite direction. Okay, so this is your confirmation. Anything before that is noise. All right, now to master liquidity trading, you need to know where to mark liquidity zones. All right, and these areas are just like I mentioned. We have equal highs and equal lows. You watch out for equal highs and equal lows. Okay, and then you can also watch out for Asian session highs and lows. You watch out for trend line bounces. You can see just like this example I gave here, watch out for trend line bounces, because when you have a break from a trend line, it might not be a real breakout. Okay, so trend line bounces are areas where you should, mark your liquidity zones, and then previous days highs and lows. Previous days highs and lows could also be areas of liquidity zones, and then obvious support and resistance zones as well. Support and resistance that are too obvious, they can be suspicious. So when price approaches these levels, don't trade the breakout blindly. Expect a trap. Okay, wait for a sweep, then wait for the shift, only then act. So liquidity trading simplifies everything because it teaches you to trade intentions, not illusions, right? Price doesn't move randomly. Every week, every sweep, every rejection, it's all engineered to collect orders. Okay, so start viewing the chart as a map of liquidity. Where would you place your stop loss? That is where smart money is aiming. So if this breakdown made liquidity trading clearer, smash that like button and subscribe to the channel for more no-nonsense trading education. Thank you for watching and look forward to seeing you in the next video. Happy trading.